but we are still speaking of very ranged movements for the month of December. What does January and 2011 hold for us? Let's get you another expert view. Joining us now is Anand Tandon, CEO of GRG Securities. Anand, welcome. Looking at the markets and the economy purely from a macroeconomic standpoint, one gets a bit of a shiver. Inflation fears already are pretty high. You saw one round of fuel price hike. Another has just barely been postponed. Today in the morning we get news about oil and egg prices being revised higher. There is almost a never-ending set of news on the inflation front. Do you think we're going to see some seminal moves from the Reserve Bank and inflation trends itself that could slow down the economy rather seriously in 2011?
Lata, I have been one of the few in the market who have been saying that the RBI is far behind the curve in terms of raising interest rates and taking steps to reduce inflation. We have somehow come to this view that there is something called a core inflation, which removes everything which goes up. So we therefore measure only those prices which are not moving and use that as a solace to say that inflation is under control. There are actually a whole lot of services which are not calculated in the indices, which are roaring in terms of prices. There are asset prices which are at bubble levels. There is absolutely no question that inflation is and will remain, to my mind, the biggest negative for the market in the next 1 year. And so far I have not seen anything which leads me to believe that that anything that either the government or the RBI is doing is going to help mitigate that.
Yeah, well, to be fair, there is one other big voice which has been voicing this concern with equal vehemence. Anand, we had Stephen Roach on the channel last weekend and accused the RBI of extremely sluggish moves with respect to inflation and sees that as a big stumbling block in 2011. But therefore, you would factor in a tepid GDP growth for 2011. I mean, would it be in the lower, closer to the 8% or even sub 8% for 2011, and therefore would an earnings trimming be in order for FY12?
Lata, on the first question, I think I have now serious doubts about the numbers that the government is putting out, because all said and done, we look at nominal growth and then use a deflator. And I have a problem with the way that we are using the deflator and the number itself. So you may actually find that if you take a deflator, if you have high inflation, you may actually get high nominal growth, and then you choose a deflator which suits the government, and the real growth may appear to be optically at least much higher than what it is. It is my belief that this is the case even in the current year. Now there is no way to challenge the numbers, therefore you go along with what it is. So I'm not necessarily sure that the growth as given by official figures will be something which will be lower. Whether that will translate into corporate earnings is something that we can certainly comment on, and I think the answer is that we are again, as analysts, perhaps using rear view driving, and when we are making an estimate for consensus showing the 25% plus kind of earnings growth, I think that will be a huge challenge, and I would personally believe that you are likely to undershoot that figure quite substantially.
Anand, morning. Putting all of this into perspective, higher inflation, interest rate concerns, corporate earnings perhaps muted as well. How would you say the equity markets would move? You think the gains would be capped at this 6100, 6200 level, or do you see us perhaps moving even lower because of these concerns?
I think you're likely to end up at best with an earnings growth of approximately 20%, and given that I still believe we are at the higher end of the range, if you assume that other things remaining the same, the market was to come back to a trend level of valuation, you can still get about 15 to 17% kind of growth in the indices on the top line for the next whole year. Now, whether it will go up in a linear way is something that is always a doubt, and I think what you will find is that the first quarter at least will end up with a little bit of a movement down, and then perhaps that will give you some reason for looking at buying into the market with some upside from there. So overall, if you ask my views on where we should expect to end the year the next year, I would think roughly about 17% up from here, in assuming that there are no other issues that crop up, especially in terms of sovereign debt in Europe.
So would all of this trickle into that one sector that has been the front runner, the banking space? I mean, there have been so many concerns fundamentally which had up until now not surfaced, and now there are concerns, deposit rate hikes, perhaps margin cuts as well. Would you be circumspect on in that space in 2011?
I think so. I think for the most part, the frontline companies are already factoring in the best earnings growth that can be factored in. There is bound to be some pressure now on margins. Unfortunately, as an analyst, it becomes difficult to look at bank profits alone because of the fact that we keep on shifting the base as far as the NPA accounting regulations are concerned, and SBI is a case in point. So if you look at it on an adjusted book value basis, I think they are factoring in most of it, and anyway, it's also one of the most overrun sectors in the market. So on both counts, I think it is not going to be a lead performer for the sectors next year.
So what could be what could bear the weight of this 15-17% rise in the indices that you are looking at? If it's not this big 26% weight banking, where would the weight fall? Would you bank on IT, I suppose?
So Lata, I think it's not as if I'm saying that the banks will come down or not perform. I'm only saying that they will perform, perhaps underperform the market. So you'll still get some upside from them. After all, there will be a book value growth. I think assuming that you are looking at a more or less non-exciting kind of market, you have to look at those sectors which haven't performed that well. Two, where there are some chances that for some reason the execution cycle may now be in favor. And in those kind of sectors, I think the bets that you can take are power utilities, power equipment, and construction companies in particular. All of them have been laggards in the year that's gone past. From what I understand, whatever we are talking to companies about, it tells us that the execution in many of the utilities, for example, especially the large central utilities, is actually ahead of the curve, and therefore should start showing up in the next couple of quarters. And with that, at least if you're a central utility, you don't have issues in terms of availability of mining rights and coal. Many of the others will. So all that put together means that you are back to looking at the somewhat more staid and boring sectors as perhaps doing better than some of the more exciting ones.
So in